Good evening, everyone. We are tonight on the 24th of Feb 2022, Thursday evening, 11 minutes past 8 p.m. Indian Standard Time. And I could think of this beautiful song, which I used to listen to a lot growing up by Scorpion, um, Winds of Change. I can imagine the music video was that of a war scene and how winds of change changes. And in the equity market, especially after today's fall, there is definitely going to be a winds of change in terms of your your approach, your anticipation and expectation from the market, and the final outcome. So we finally had a big gap down, right? Um, the daily chart of Nifty Newman futures. I love the bar charts. I prefer them, but I think you're more comfortable using the candles. Is it? Or let's stick to the bars. So, a couple of days back, we were talking about this range, and in today's trade, the market gaps down with this. So, this today's bar can be very as well be classified as a breakaway gap. The trend was anyways down, and I was bickering all the time. Trend is down, stay cautious, careful, long trades, keep them limited, short trades, you can sit on them, and all that bickering over and over again now. um, it has opened up big time on the downside. Moving averages had come very close to each other, and when they generally come close to each other, they open up, and I think I've been talking about that as well. And hello, we have kind of opened up. This was a big fall. This was quite an impressive fall, close to 5%, 830 points in just one day. Um, is 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 a day to remember. It's not going to be forgotten that easily. Especially if you've entered the market recently over the last couple of years, then welcome. This is another side of the market now you have to experience. If you notice, I just dragged this green range. This green range was a very old one, which we had drawn long time back in these periods when the market was coming down. And the primary reason of marking with this wide green section was this volume profile. Um, this volume profile was drawn from this low to this high, and the majority of the volumes during that span was noticed up there, which led to this support, very old one. And after that, the next zone where the volumes was of some importance was within this green zone, and that led to the late December 21 bounce. This got me surprised. This from this point onwards to this point, I was like, I wasn't too sure what was happening. Nevertheless, now if I extend this, welcome. The index is right there. So are we looking at a bounce back? I don't think so. It's going to happen immediately, though it's an important zone, important level. But the nature of today's fall, the way it fell, the way it didn't even manage a smallest bounce back. It was there in the first hour, and after that, it was throughout the day weak, beaten down across the width of the market. I don't think this time it's going to bounce back from here. If it does, of course, it will be a surprise. If it does in a V-shaped manner, it will be a surprise. But I don't think so. Even if it does, it will face some selling pressure going ahead. Going ahead, selling pressure very likely to kick in from the earlier support zone. What doesn't kill you make you stronger. That's the day we discussed about the supports, and this is where you're very likely to face the resistances coming in. You can keep a nice volume profile dropped just to check how it plays out. As of now, there was clear sign of redistribution happening up there. So trend was down, trend is down, momentum has picked up on the downside, big fall for the long-term charts, and I use the weekly as my long-term charts, and they're on the verge of a little bit of correction. 75-minute box over here is getting plotted in all the time frames. You go to visibility and just just uncheck where you don't want it. Nice. So see, these are times where prices find value, prices go away from value on either direction of value itself, and these are the times where it is essentially reverting back to price, reverting back to value. There can be multiple levels that one can look at. I would suggest, as a trader investor, you should start focusing on long term levels now. The stocks and sectors where you have some interest, you should start focusing on them. Draw some long term supports and resistances zone with volume profile if you can. It will be useful. So I'm going to do that for you over here in Nifty as an example. It doesn't make any sense to talk about the other sectors or the stocks. All of them are beaten down. So might as well spend some time talking about the Nifty and what should be the levels we should focus upon. So here we are. I'm going to focus from the March 23rd, 2020 low to the recent high that we had here and try and understand where can we expect any kind of support, if at all. First, I'm going to focus on some congestions, erstwhile range congestions, which had kept the market consolidated for some time. So I can see this one, which was close to the Feb 21 highs, which also kind of matches with this June July consolidation. This one, so that's one. Apart from that, this market did manage to spend some time here. This was quite a wide zone, and I'm not going into volume profile or Fibonacci, whatever whatsoever right now. Just focusing on past volume levels. Sorry, price congestion zones. Now let's drop a volume profile, the big one, from this high all the way up to the top. And this volume profile coincides with this range. And this one, which is close to that 15,900 and below towards 15,500, I think we should write them, write these levels. It will be easier. So we are looking at around 15,500 to 15,900. Quickly check. 15,500. 15,997. So this is essentially 16K. 16K. I think green will be more appropriate towards the bottom. Yeah, this looks good. And so this volume or point of control is essentially there. Now let's quickly drop a Fibonacci retracement. 23%, 23.6 coincides with 16K. Then we have 38, which is close to this zone. Then we have 650, 61, and then the 76.4, 78.6. I'm going to quickly drop a extension, or I would rather say projection of this fall down. If it opens up on the downside, then I would like to know where all can I expect the um, the targets of fall. So as I can see, it's in red. I'll keep them in red. I will mark the resistances in green so that I can differentiate between the nature. I like trading view, which manages to, allows me to do these kind of nice aesthetic stuff. So, quick drop of volume profile and Fibonacci. And what do we see? Number one, 16K, 15, 850, 15, 16K, little below 16K, 15,900s is the level, which is very, very likely that the index will come. In fact, it should come to this zone, which is this one, and consolidate maybe this fall. This fall, this bounce, and the next fall. This particular fall should somewhere in this zone should at least stop for a couple of days, if at all. Um, so this is one zone that we will be focusing upon, and then it becomes little difficult and it becomes little wide. I have 15,100, I have 14,335, 14,500. I have a point of control which is 14,800. So this range is a difficult one to expect any kind of support, but it's a fairly wide one. So let's see. And as of now, the worst, let me call this a worst case scenario for this correction. It can get worse than this. Is close to the 13K mark. Nothing much in terms of volume profile, but I've got a beautiful confluence of two Fibonacci, one a projection, one a retracement. So we have marked these levels, and we will look how the market unfolds as it approaches. And these kind of things should be done based on the weekly charts. Just as I was looking at this weekly chart, just thought of doing a little bit of stunt. If I plot the auto pitchfork, will it not? Okay. I was just thinking, will it plot it on the downside? Will it take me on the downside? The auto pitchfork, in the sense, will it take this and mark it on the downside? I'm not a big fan of these. I've never actually walked at length drawing these pitchforks and shift pitchfork and modified shift. I actually do not understand these things that much. So I was expecting the auto pitchfork to behave something like this, which it didn't. It took the rising trend ones, and so let's see what's in store. But welcome to a very early stage of a bear market. Do remember that markets are in a very reactive mode and will keep on reacting to all the good news and of course more so the bad ones, the negative ones, which will trigger selling. As I was, repeatedly suggesting, trade less, protect your profits, sorry, protect your capital. These are not the times where you should focus more on revenue or returns, but more on consistency and preservation. And if you've been hurt by today's fall, then you would understand what I'm saying. Please do that, because my past experience suggests that we should not predict the bottom, but we can start preparing ourselves to start to accumulate some good quality stocks or index funds, and track the market better, closer. Just remember one thing: these are excesses. Means, for example, I'll sign off by saying that, which I think said in yesterday's video, that from a certain point to a certain point, you had experienced the market in a completely different manner. And after that, markets will stabilize. The excesses of excess profits that it generated, that will be shelved off, that will be given back, and then it will stabilize, and a new leg up will begin. So this is markets. This is how markets have always been and will always be like this. Depends on how well you have prepared yourself to handle that. So all the best with your trades. I hope that if you're a derivatives trader, you've made most of this fall and made good returns. If not, if you're predominantly on the long side, just stay put and start doing some serious homework, right? And above all, take care of yourselves. Trade well, trade wise.